global financial markets, there's basically this dominant narrative, right?
Right, yeah. Like a single clear story that kind of dictates how all the capital flows.
Exactly. But right now we are looking at the market equivalent of like a massive suspension bridge that is just under extreme stress.
Oh, absolutely.
Because on one side, you have this hurricane force wind trying to tear the whole bridge down. And that's the severe physical geopolitical tension in the Middle East, right? The stuff that's threatening global oil supplies.
Yeah, the physical reality of it.
Right. But then on the other side, you have this thick steel cable holding the entire structure in place. And that is this unstoppable, completely cycle-agnostic wave of AI corporate investment.
It's honestly a genuinely historic divergence. I mean, the fundamentals of heavy industry, shipping, energy, they're all pricing in this localized panic. Well, the mega cap tech sector is essentially, just ignoring the geopolitical reality entirely. They're operating in two completely separate financial realities right now.
It is wild to watch. Well, welcome to Market Recap. I'm Daniel.
And I'm Mira.
And today is Monday, April 20th, 2026. We've pulled together the daily market briefings, equity and commodity data, and macroeconomic research to really unpack the sheer whiplash of today's trading.
Whiplash is definitely the word for it.
Yeah. Our mission today is to help you understand the fundamental logic behind these wild market moves and, really establish the baseline operating environment that you're navigating right now.
Right. But just to set the ground rules really quickly before we start.
Oh, yeah, good point.
So we are going to be unpacking some highly charged geopolitical events today involving the U.S., Iran, and the current administration. And we just want to say we are entirely neutral here.
Completely.
We are not endorsing any political viewpoints. We are strictly reporting the facts straight from the source material to explain how the markets reacted.
Yeah, exactly. And I'll just add the mandatory reminder that this deep dive is strictly for market context and discussion, right? It's not personal investment advice or like an investment recommendation.
Got to get that out of the way.
Always. All right, so let's open session one. What actually set the stage before the U.S. trading session even opened? Because to understand the absolute chaos of Monday morning, we kind of have to rewind to the carryover narrative from the weekend.
We do, yeah. Because over the prior weeks, we had this escalating U.S.-Iran conflict, which, culminated in that really fragile Pakistan-brokered 2-week ceasefire.
Right, which is exactly where the financial physics start to break down, because the underlying logic the market was tracking over the weekend was this classic energy shock transmission channel.
Right.
When a geopolitical conflict physically threatens the Strait of Hormuz, which, is a choke point that handles basically a fifth of all global seaborne oil, energy prices don't just rise, right? They violently dap up.
They absolutely explode. And, that mechanically feeds straight into broader headline inflation.
Exactly. And when inflation fears rise, central banks basically lose all their flexibility. They're forced to keep interest rates higher for longer just to cool off the economy.
Yeah.
But let's break down why that specifically terrifies the equity markets. Because it fundamentally changes how stocks are valued through something called multiple compression.
Right. Multiple compression. That is the critical mechanism here. Think of it kind of like this. When you buy a stock, you aren't really buying the company's past, right?
Right, you're buying its future.
Exactly. You're buying a claim on its future earnings. So to figure out what those future earnings are worth today, you have to discount them back to the present. And you use a baseline interest rate for that, usually the U.S. Treasury curve. So if inflation fears push that baseline interest rate higher, the present value of those future earnings mathematically shrinks.
It's kind of like gravity turning up. The heavier the interest rate gets, the harder it is for high-flying tech stocks, which, let's face it, are valued almost entirely on earnings a decade from now. It's harder for them to stay aloft.
That's a great way to put it. And, on top of that gravity, you add the equity risk premium.
Oh, right.
Which is just the extra return investors demand simply to hold a risky stock instead of, say, a perfectly safe government bond. So when war is suddenly on the table, uncertainty skyrockets. Investors demand a much higher premium.
So stock prices literally have to fall to offer that higher return.
Exactly. A rising discount rate combined with a widening risk premium equals a brutal sell-off. And that was the baseline fear heading into the weekend.
A fear that was violently reignited on Sunday. The U.S. Central Command reported that a guided missile destroyer intercepted an Iranian-flagged cargo vessel in the Arabian Sea.
Yeah,
and they actually fired into its engine room after repeated warnings and then boarded it. And immediately following that, Iran's top military command officially accused the U.S. of a ceasefire breach. This was Sunday evening, like 5:47 p.m. Eastern Time.
I mean, that is the literal nightmare scenario for the Alcos. It's a direct kinetic military engagement.
Right. And the rhetoric didn't stop there. By Monday morning, ahead of the U.S. Open, around 3:37 a.m. Eastern Time, an Iranian foreign ministry spokesman explicitly stated they had, quote, no plans for a second round of talks with the U.S., specifically citing those ceasefire violations.
Yeah.
This wasn't just tough talk anymore. It really looks like the diplomatic off-ramp was entirely closed.
And you can imagine what that did to risk appetite the second the Asian markets opened.
Oh, it was a bloodbath.
Totally. The rhetoric caused this severe gap down. We saw Brent crude jump roughly 7% to nearly $97 a barrel in early Asian trading.
Wow.
At the exact same time, S&P 500 futures fell almost a full percent, and the U.S. dollar caught this massive safe haven bid as capital just fled to safety.
Okay, but I have to challenge this reflexive panic for a second.
Okay, go for it.
Because when you look at the financial media, they almost always frame these geopolitical escalations like unpredictable natural disasters, right? Like a hurricane hits, an earthquake happens, you just sell.
Yeah.
But if we view that Sunday ship seizure and that really harsh Monday morning rhetoric through more of a game theoretic lens, the entire picture shifts.
How so?
Well, Wednesday is the hard deadline for the ceasefire, right? So to me, this looks a lot less like a permanent collapse of diplomacy and much more like calculated 11th hour posturing.
Ah, okay.
Both sides are just trying to maximize their leverage right before a massive diplomatic deadline.
Look, I hear that game theory argument, and it makes total sense in like a political science seminar.
Right.
But try telling that to a shipping insurance actuary,
Yeah.
When bullets are physically hitting a hull in the Arabian Sea, algorithmic trading models do not care about diplomatic 4D chess.
Fair point.
They only care about insured losses and blocked shipping lanes. Like, if it's a natural disaster, yes, the structural damage is permanent. If it's game theory, sure, the risk premium can vanish the second a deal is signed.
Right, goes to zero.
But heading into the U.S. morning, those early traders and the algorithms, they weren't going to wait around to see who would blink first. They were forced to price in the absolute worst-case scenario right then.
Yeah, that tension between the diplomatic game theory and the physical risk is exactly what bled into the U.S. Open, which, honestly, is a perfect place to pause. We'll take a quick break, and when we come back, we'll dive right into the sheer chaos of the U.S. trading day.
Sounds good.
All right. Welcome back. Let's dive into session 2. What moved markets during U.S. trading hours? Because if you were watching the tape on Monday morning, you were getting absolute whiplash.
A whiplash might be an understatement. I mean, right after the opening bell, at 8:34 a.m. Eastern Time, Kuwait Petroleum Corporation actually declared force majeure on oil shipments due to the Hormuz blockade.
Let's clarify force majeure for a second, just because it's a term thrown around constantly in these crises.
Good idea.
It basically means act of God or, an unavoidable catastrophe. It's a legal trapdoor that allows a company to break a contract without any penalty because outside circumstances have made it literally impossible to fulfill.
Exactly. And in the oil market, invoking it is an earthquake.
Yeah.
Because it means this isn't just rhetoric anymore. It is physical, legal confirmation of a supply disruption. It tells every single refinery relying on that Kuwaiti oil that the crude is genuinely trapped.
Right. They aren't getting it.
No. So those buyers now have to flood into the spot market and buy replacement barrels at whatever price they can get, which spikes the global price instantly.
But the absurdity of Monday morning is that literally 1 minute after that force majeure hit the wire at 8:35 a.m., Eastern Reuters dropped a conflicting report.
Unbelievable timing.
Literally 60 seconds later, they cited sources saying the doors actually remain open for U.S.-Iran talks. So you have a physical supply shock driving prices up, and then the spark of diplomatic optimism pulling them down, hitting the trading terminals a minute apart.
It's algorithmic chaos. I mean, the trading bots are scraping these headlines in milliseconds, trying to weigh physical oil shortages against diplomatic whispers.
Right. And then the rhetoric from the U.S. side escalated aggressively. At 10:03 a.m. Eastern, President Trump was on PBS News, warning that if the ceasefire expires on Tuesday, quote, lots of bombs start going off.
Yeah, that was intense.
And less than an hour later, at 10:51 a.m., in a Bloomberg interview, he stated that an extension of the truce was highly unlikely and confirmed the deadline was Wednesday evening.
Okay, but this is where I think we really need to point out a fascinating discrepancy in the data.
What's that?
Well, we just outlined a morning where a physical oil choke point was legally confirmed closed, and the U.S. president explicitly warned that a hot war was imminent, right? Historically, you would expect a massive, across-the-board equity rout, just an absolute bloodbath.
Right. The market should tank.
Exactly. But if you look at the actual indices, the market was surprisingly immune to all this intraday headline noise. I mean, the S&P 500 only saw a modest risk-off pullback.
Really modest.
It closed down just 0.2% on the session.
Yeah.
It barely flinched. So I have to challenge you on this. Why didn't the market tank?
It's a great question. And I think the most logical explanation is that the absolute worst case geopolitical scenario was simply already fully priced in by institutional investors over the weekend.
So the smart money weekend stress test.
Exactly. Institutional portfolio managers looked at the board on Sunday night. They modeled the shipping conflict. They modeled the breakdown of talks, and they adjusted their portfolios accordingly.
Right.
So by Monday morning, when these scary headlines are hitting, they essentially looked at the news and said, okay, yeah, we already planned for this. Show us something worse.
And because the headlines were just confirming what was already modeled in those massive spreadsheets, the selling pressure was exhausted.
Completely exhausted. There was literally no one left who wanted to panic sell. And that exhausted setup perfectly explains the massive reversal we saw in the afternoon.
Yes, the timeline of that reversal is critical.
Yeah.
The turning point actually happened right before noon at 11:25 a.m. Eastern Time. Pakistan's foreign ministry confirmed that a high-level Iranian delegation had actually arrived in Islamabad for the talks.
Which proves that the early morning claim that they had no plans to talk was entirely a bluff.
Exactly. Vindicating your game theory read from earlier.
Right.
Both sides were completely posturing.
Right.
And then the massive catalyst hit early in the afternoon. At 1:41 p.m. Eastern, President Trump posted on Truth Social that the talks were, quote, very good and productive, and a deal could come soon.
Even though, remarkably, Iran officially denied the negotiations had even taken place.
Classic diplomatic theater.
Yeah.
But fundamentally, look at how the market processed that information. The instant that post hit, the geopolitical discount rate we talked about earlier, it just dropped through the floor. The threat of immediate U.S. airstrikes basically vanished from the models. And the second that macroeconomic headwind disappeared, the market's incredibly strong forward earnings outlook just grabbed the wheel.
It was a V-shaped recovery in real time. I mean, U.S. equities finished sharply higher on the news. The Dow surged up 1.38%, the S&P popped 1.15%, and the Nasdaq rallied hard, also up 1.38%.
And the energy markets.
Yeah.
They suffered a total collapse. U.S. crude plummeted over 9% to close all the way down at $88.84.
Wow. It was just a collective sigh of relief priced in billions of dollars.
Yeah. But before we move off the trading day itself, we do need to highlight a structural policy move that happened right around the closing bell.
Oh, right. The Defense Production Act.
Exactly. At 4:15 p.m. Eastern Time, the White House invoked the Defense Production Act for energy supply chains. This covers domestic petroleum, natural gas, coal, and grid infrastructure.
And the Defense Production Act is a massive lever. It essentially allows the federal government to compel private companies to prioritize government contracts or even force them to expand production of essential materials.
Yeah.
By invoking it for energy, the administration is attempting to put a medium-term structural cap on inflation. They are basically signaling to the market, look, if we can't rely on the Middle East for supply, we will legally force domestic capacity to expand.
It's a direct attempt to neutralize that energy shock transmission channel right at its source.
Yep.
It tells those algorithms that even if the Strait of Hormuz stays messy, domestic supply is about to get a massive state-sponsored steroid injection.
Exactly.
So just to summarize this wild trading session, we went through a full financial roller coaster. We started with physical force majeure and threats of bombs, digested it all because it was largely priced in, and ended with a massive relief rally on a ghost diplomatic breakthrough.
Just a normal Monday, right? Let's take one more quick break. When we come back, we're going to unpack the corporate data that actually kept the market afloat while all this was happening.
See you in a minute.
All right, let's open session 3. what were the key corporate events and what should we watch next? Because, a market doesn't just rally in a vacuum. It needs a reason to go up, not just a reason to stop going down.
And that reason is the AI counterweight we mentioned at the very beginning of the show.
Right.
The real reason the market was so eager to rally today is because the underlying business fundamentals in the technology sector are historically undeniably strong right now.
Right.
We're in the middle of a massive cycle-agnostic AI infrastructure boom.
I really love that term, cycle agnostic. It basically means these tech companies are going to spend this money regardless of what inflation is doing, regardless of where interest rates are, and completely regardless of what happens in the Arabian Sea.
Precisely. I mean, think about the weekend context that really set this up. We had Reuters reporting on Sunday that Google is in talks with Marvell to build new AI chips.
Mm-hmm.
And on Saturday, Tesla announced the expansion of its robotaxi service to Dallas and Houston.
The technological rollout is just bulldozing right through the geopolitical crisis.
It really is.
But the big corporate event today, the one that perfectly illustrates this extreme capital concentration, dropped right after the closing bell at 4:31 p.m. Eastern Time. Amazon announced it is expanding its partnership with the AI firm Anthropic by up to $25 billion.
$25 billion. Let's just break down the mechanics of that deal because it's fascinating. It's $5 billion immediately, right?
Right.
And then another $20 billion tied to commercial milestones. But the flip side of that deal is the real story here. Anthropic committed to spending more than $100 billion on Amazon Web Services over the next decade.
It's literally a boomerang investment. Amazon hands Anthropic billions of dollars, and Anthropic just turns around and uses that exact money to buy computing power back from Amazon's cloud servers.
Yeah, it's a completely closed-loop ecosystem of capital. And that staggering capital velocity perfectly illustrates our point about capital concentration, just overriding broader macro headwinds.
Mm-hmm.
Think about the venture capital data from the first quarter. AI startups captured $242 billion.
That is massive.
But get this, $188 billion of that went to just 4 companies: OpenAI, Anthropic, xAI, and Waymo.
This incredibly narrow band of tech hyperscalers is basically carrying the entire equity rally on its back, and the market loved the news, right? Amazon stock jumped 2.3% in after-hours trading.
Yeah.
It really highlights how disconnected the tech sector is from the physical economy right now. A barrel of oil can spike to $96, and Amazon will still write a $25 billion check because they are playing an entirely different game.
Which is exactly why the tape today was so disconnected from reality.
Right. What a day on Wall Street, where the market's primary technical indicator was basically Donald Trump's cell phone battery. I mean, we started the morning pricing in World War III and ended the afternoon celebrating a diplomatic breakthrough that one side doesn't even admit happened. I guess the only thing moving faster than crude oil prices today is the Amazon delivery driver dropping off Jeff Bezos's $25 billion check to Anthropic.
Right.
Congratulations to everyone who survived the whiplash, because trading this market feels less like finance and more like extreme couples therapy.
It definitely requires a strong stomach. So, looking ahead, what should we be watching for the next 24 hours to see how this all plays out?
Tomorrow, Tuesday, April 21st, is heavily data-driven. Right around 8:30 a.m. Eastern Time, we get the Census Advance March retail sales and the Philly Fed non-manufacturing survey.
Okay, this is critical because it will give us a real-world read on the consumer's health amid all these inflation fears. We really need to see if the higher energy prices over the last month are actually starting to choke off everyday spending.
Exactly. Then, before the open, we have first quarter earnings from defense giants RTX and Northrop Grumman. And given the macro backdrop we just spent the entire show dissecting, their forward guidance is going to be hyper-relevant.
Oh, totally. The defense sector is practically a geopolitical proxy right now. We'll definitely be listening closely to what they say about their backlog of orders.
Later in the morning at 10 a.m. Eastern, we get the Census February manufacturing and trade inventories. And finally, at 11:30 a.m., the Treasury's 6-week bill auction closes.
Which gives us a real-time look at short-term liquidity demand, right?
Yeah.
Like, are investors still hiding in cash, or are they stepping back out into risk?
Right. It is going to be a packed day to follow a chaotic day. But to wrap this all up, there was one provocative thread we haven't fully pulled on yet.
What's that?
We've talked extensively today about how this extreme capital concentration in just 4 AI hyperscalers is essentially what saved the broader market from a geopolitical energy shock today. The fundamentals of those tech giants basically acted like a fortress.
They absolutely insulated the major indices.
But it really makes you wonder, at what point does that exact concentration become its own systemic risk?
Oh, that's a good point.
Right. If the entire market's safety net is tied to the capital expenditure budgets of just 4 companies executing these massive closed-loop investments, what happens if that specific AI trade unwinds?
Yeah.
If those earnings miss, entirely independent of what happens in the Middle East, the market won't have a suspension bridge left to stand on.
That is the multi-trillion-dollar question right there.
They won't.
Well, let us know if you think this AI safety net can hold up against global disruptions by sharing your thoughts in the comments below.